Welcome to The Interest. I'm Ryan Kingsley. This Thursday, we're joined by LaDonna Lockard in a new segment of Maximum Conversations in Minimal Time. After that, Vincent Valvo delivers another Poetic Moment in mortgage. Then stay tuned for Mortgage Meteorology with Sarah Wolak. Before we hear from Sarah and LaDonna, a new report from the digital insurance broker Matic reveals that the coverage and cost of homeowners insurance have worsened through the first half of 2024, as challenges bringing instability to the insurance market persist. Home insurance is required for properties purchased with mortgages backed, in one form or another, by the government. The escalating frequency and severity of extreme weather events in recent years have caused providers to dramatically hike rates where state regulations allow, go insolvent, or exit markets altogether, straining state insurers of last resort, such as Florida's Citizens Property Insurance Corporation and California's FAIR Plan. National Mortgage Professional has been reporting on the evolving insurance landscape and brings you these insights from Matic's latest research. In 2022 and 2023, a number of barriers to profitability facing the home insurance market coalesced, resulting in a lack of coverage, availability, and affordability for borrowers and homeowners across the U.S., and especially in hard-hit markets like Florida and California, directly impacting mortgage professionals there too.
The property insurance market over the last couple of years has endured massive losses. Inflation pressures, cost of goods, and a lack of pricing control. They have a lot of pricing control, but there's a lot of limitations on changing prices.
Those challenges have persisted through the first half of 2024, according to a mid-year trends report published by Matic, a digital insurance broker. The report draws insights from a data set of 36 million quote requests across 10 million properties, including external quoting. Through the first 6 months of the year, homeowners faced an average 17.4% premium increase for new policies, compared to 11.6% in 2023 and 5.9% in 2022. Matic also found, however, that homeowners who stayed with the same carrier and policy each year experienced steeper increases than those who shopped around, with those who purchased a policy in 2021, for example, now paying 69% more for the same policy in 2024. A consequence of new business restrictions, carrier withdrawals from high-risk markets, and regulatory challenges, the average number of home insurance quotes available per person nationally fell by 27% from June 2023 to June 2024. Another trend highlighted is the growing share of underinsured properties. Roughly 2/3 of homes are underinsured, Matic reports, the result of insurance policies failing to reflect current costs of reconstruction and home improvements. Dwelling coverage experienced sharp increases from 2021 to 2022 due to rising costs of building materials and labor, but those increases began to slow in 2023 and have continued to decline into 2024. Ultimately, coverage amounts aren't keeping pace with rising premiums. Fannie Mae published a selling and servicing bulletin in mid-May that said the Federal Housing Finance Agency, or FHFA, would be temporarily suspending citations of lenders and servicers for, quote, non-compliance related to obtaining property insurance replacement cost values for the purposes of determining coverage amount sufficiency.
There's always been a requirement to have a minimum insurance amount, to be covered by the loan amount or the replacement costs in the GSE guides. But there has never been sort of guidance on, well, do you actually need to get a copy of the carrier's replacement costs estimate?
From appliances to construction materials to labor, a few years of inflation have driven up insurance providers' costs of replacing these things in homeowners' policies. The costs are passed to policyholders in the form of increased rates. But some renewals for existing policies may have higher premiums for less coverage if the replacement costs in a 2019 policy aren't updated. For insurers, replacement costs are more often higher than the cost to replace an item for its actual cash value, which takes depreciation into account, for example. Replacing an old roof for its cash value leaves a homeowner, and thus the bondholders, many thousands of dollars short of the cost of a new roof.
They all have teams focusing on this to say these markets are changing. The risks to our bondholders are different. The risks to the customers are different, and we need to start setting it. And so as there's been sort of focus on it, there's been, I think, a realization that we need to look at these risks differently to make sure that we're protecting the bondholders and the customers in the way that these guidelines were intended to support them.
The gap created by policies with insufficient coverage, leading to underinsured homes, presents a larger problem when disasters hit.
And if the customer's replacement cost is in the insurance policy $1,000, but the servicer thinks it should be $2,000, how do they solve that spread?
To learn more about how originators and lenders are overcoming challenges in the home insurance market, visit nationalmortgageprofessional.com. For The Interest, I'm Ryan Kingsley.
We all dream of owning a home, but for too long, if you didn't fit the mold, you were stuck. Stuck because the system worked for everyone except you. We've changed that. Angel AI uses advanced AI technology to give a 100% trusted solution and fast answers for worry-free financing, allowing you to achieve fair and equal access to lending. Angel AI. AI you can bank on.
For The Interest, I'm LaDonna Lockard. I'm here today with Megan Anderson. Megan, you are the VP of Client Relations at Highway AI. Go ahead, walk me through a little bit. How did you get your start in this industry?
Well, it's so funny in this industry because no one gets here growing up saying, I want to get into the mortgage industry. And my story is very much the same. At the time, I was actually a personal trainer and I was living in Las Vegas, and I ended up working conventions. And one of the conventions I ended up working was the big mastermind convention in Las Vegas. And that is where I met Barry Habib, and he offered me a job at the time. And, I've been here ever since. I can't believe it's going on almost 9 years at this point in time.
That is wild. What a fun introduction into the industry. And you're so right. No one ever grows up thinking that this is going to be the industry that they end up in, but it has that way of just kind of sinking into you and keeping you in it. So now that you've been with them for almost a decade, obviously there's a little bit of a twist to the name. I've always been so used to MBS Highway. Now it's Highway AI. Tell me a little bit about what's going on with that.
Yes. So many of you know us as MBS Highway. And even to this day, it is hard for me as well to make the shift to calling us Highway. But about a year ago, we acquired List Reports. Many of you know the platform List Reports. So we rebranded as Highway. Ultimately, at the end of the day, it's been a fun journey to grow and add to the product list and, reach more and help more people at the end of the day.
What's your role look like with them? Walk me through kind of the day-to-day life in Megan. What is it exactly that you're doing there?
So a lot of things, still wear a lot of hats at the company. At the end of the day, a large portion of the job is, getting Highway out there, being on podcast episodes just like yours, reaching out to individuals, doing training webinars for our various corporate clients, just kind of getting the word out there.
What is the kind of big evolution that you're seeing coming forward? Obviously, AI is taking over. It's on everyone's minds. What does that look like for you and the service that you're providing?
Well, the first thing that kind of comes to mind is a new tool that we just launched, actually. It is called Home Report. And I really think it's important to talk about it because we know at the end of the day that the Federal Reserve is done hiking rates. In fact, we're going to hear from them today at 2 p.m. Eastern if they are going to cut. We don't believe so. We think it's going to be in the next meeting. But once they do, we are going to see mortgage rates decline. And for the past 2 years, there's been over 10 million purchase transactions. What that is going to do is it's going to create a beautiful refinance opportunity. So I am advising individuals, do you have the system and processes in place to capture that business when we do get that refinance boom? And if you don't, well, we have a new tool called Home Report, which is essentially, it pulls in your past database and it's a monthly cadence, and it shoots them an email every month letting them know what's going on, with their home value, highlighting different things to them, really making it so that you stay top of mind so that you're going to capture that business and that opportunity when it comes.
You're so right. The opportunity is coming and it's knocking at our doorstep. So it will be here before we know it. Do you have any other advice that you would give to people on how to prepare for what hopefully becomes a mini refi boom coming up?
Just the biggest thing is just getting out there, whether it's calling your past database or just making sure that you are staying in contact with them. When you do stay top of mind and that opportunity arises, you want them to ultimately think about you at the end of the day. And, you also just mentioned AI, incorporate and learn how to utilize AI. I've been traveling around the US talking about AI now for the past year, and everyone always has the same question, is it going to take over my job? It's not going to take over your job, but at the end of the day, if there's someone out there that knows how to use it and incorporate it, they're going to take over your job. You don't want to be like my mom, I love my mom right now. I love her to death. But when it comes to social media, she's like, how do I do this? How do I post this? Right? You don't want that to be you. And I'm here to tell you that if you were going to stay in this industry for any longer, 2-5 years, however long you're going to stay in here, you don't have the option to not learn how to use AI. And I just got back from the Housing Wire AI Summit, where you speak to and listen to C-level executives and how they're using AI and the future that they see in AI. And we're not getting away from it. So take the initiative every day right now to learn and see how you can start to incorporate it in your daily activities to capture more business.
Fantastic advice. Otherwise, you really will become irrelevant if you're not willing to adapt and to change. Speaking of changes, I have to ask you about this. Girl, you're living in a van right now. What is that like for you? Why did you decide to do this? I mean, maybe give me the biggest highlight of what you're going through right now.
Yeah, so the van life was a dream that I had over a decade ago when I was a personal trainer. And I got what my mom called a real job here at Highway. And then it just kind of came back. I was experiencing a little bit of burnout with traveling around speaking all the time. And life just so happened, I'm at a place where I don't have anything really tying me down. And I said, is this going to be something where I'm on my deathbed and I'm like, man, I wish I would have done that. I wonder what that would have been like. And I'm like, no, I'm not going to do that. I'm going to do this right now. The opportunity has presented itself. And so I'm currently on about day 30 of van life. And it has been incredible. It has been so grounding to be in nature, and everything runs off of solar. And I got to tell you, with work-life balance, it is so great at the end of the day to just flip my little power switch and the entire world disappears.
Amazing. Well, it's been so fun chatting with you. I know that we're going to continue this conversation. So thank you for being here. Thank you for joining me. And for the interest, I'm LaDonna Lockard.
In the neon-lit heart of Vegas, where dreams ignite, where mortgage minds converge, ablaze with insight, a gathering grand where industry titans convene to forge the future of homes, unseen and serene. The bustling booths, the speakers stage, ideas spark like fireworks in an industry sage. Networking pulses through corridors wide. Innovation blooms where thoughts coincide. It's Originator Connect, a beacon so bright, where knowledge flows freely day and night. In the pulse of each session, wisdom is born, shaping the path where mortgages adorn. Amidst the desert's heat, this gathering stands tall, a testament to vision, surpassing all, for in this domain where greatness unfurls lies the greatest mortgage conference in the known world.
back to this week's Mortgage Meteorology, where we'll touch on all things to do with the overall climate of the housing market. Not just in our neighborhood, but yours too. Bird, did it just get cold in here? That's probably because a cold front has settled over the housing market, meaning that activity isn't as hot and happening. Nearly 2/3 of homes listed in June lingered on the market for at least 30 days without finding a buyer. This figure has billowed up from last year's, which was under 60%. According to Redfin, June's numbers mark the most considerable annual rise in a year and the highest level for June since 2020. And speaking of June marked the 4th consecutive month of rising home listings lingering on the market, leading to a growing accumulation of unsold inventory. This overcast market is largely due to buyers experiencing cold feet in the face of record high home prices and elevated mortgage rates. Texas and Florida are experiencing the most intense pockets of this cold front. In Dallas, 63% of listings in June sat on the market for at least 30 days, a sharp increase from 52% last year. In Florida, Tampa, Fort Lauderdale, Jacksonville, and Orlando are all seeing significant upticks in stale listings. The increase in unsold inventory in these states is partly due to a lightning surge in new home construction, adding to the supply when demand is cooling due to high housing costs, including rising insurance and HOA prices. Nationwide, over 40% of homes were on the market for at least 60 days in June, which is only slightly higher than last year's 38.4%. But despite this seemingly small shift, this marks the hottest annual increase in nearly a year and the 3rd straight month of rising long-term listings. Redfin says that the broader market may continue to experience this cooling activity trend unless there's a significant shift in mortgage rates or pricing strategies. Stay tuned for updates as these market conditions evolve. Until next time.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.